Welcome back to the channel. Today we're analyzing one of the most fascinating technical setups in the silver market. As of mid-February 2026, silver is trading around $82 per ounce, and we're breaking down the critical support and resistance zones every trader should watch. Before we dive into charts, let me be clear. This is purely educational content, not financial advice. You should always conduct your own research and consult with qualified financial advisors before making investment decisions. With that established, let's explore what's happening in the silver market because the story is compelling from both technical and fundamental perspectives. Market context and recent volatility, 134 down. To understand where we are today, we need to briefly acknowledge the extraordinary volatility we've witnessed in recent weeks. Silver hit an all-time high of approximately $121 per ounce on January 29, 2026, before experiencing what many are calling a historic correction. We saw a dramatic sell-off that brought prices down as low as the mid-70s in early February. As of February 15th, silver is trading around $82.49 per ounce. Now, even after this correction, silver is still up more than 150% from where it was trading a year ago. Think about that for a moment. We're looking at levels that would have seemed almost impossible just 12 months ago, yet here we are, consolidating in what appears to be a new structural price range. The recent volatility has actually done something important. It's helped establish clearer technical levels for us to work with. Markets never move in straight lines, and these consolidation periods are where meaningful support and resistance zones get tested and confirmed. Current price action shows silver attempting to hold above the $80 level, with buyers defending this area fairly aggressively. Let's look at what the technical picture is telling us. Support analysis. The 69.70 zone, $4 7 hour. Let's start by examining the support structure beneath current prices. The most significant support zone we're watching is in the $69 to $70 range. This isn't just an arbitrary level. It represents a confluence of multiple technical factors that make it particularly important. First, the $69 or $70 area corresponds with previous resistance from late 2025 that has now flipped to support. In technical analysis, we often see former resistance levels become support once they're decisively broken, and that's exactly what we're observing here. Second, if we look at the moving averages, particularly the 200-day moving average, we can see it's providing dynamic support in this general vicinity. The 200-day MA is one of the most widely watched indicators among institutional traders, so price action around this level tends to be significant. Third, from a psychological standpoint, the $70 level represents a major round number. These whole numbers often act as magnets for price action because they're reference points for traders globally. We saw consolidation around $70 multiple times in late 2025 and early 2026, which reinforces its importance as a structural level. What would a test of the $69 to $70 support zone mean? From a risk management perspective, if you're watching this level for potential long entries, you'd want to see how price behaves if it gets there. Does it bounce immediately, showing strong demand? Or does it hesitate, potentially suggesting more downside? These reactions give us valuable information about market sentiment. Below $69, the next major support would likely be in the $60-65 range, but we'd need to see a significant shift in market dynamics to reach those levels given current fundamental support. Resistance analysis, the 82 to 84 zone, 7 to 10. Now let's flip the script and look at what's capping the upside in the near term. The $82 to $84 zone is functioning as current resistance, and understanding why is crucial for anticipating potential breakouts. As of today, silver is trading right at this resistance level, around $82.40. We've seen multiple tests of the 83-84 area over the past week, with price struggling to establish a foothold above it. This tells us there's selling pressure or profit-taking occurring at these levels. The $84 level is particularly significant because it represents the 50-day exponential moving average in some time frames, and it also aligns with recent swing highs from earlier in February. When you get multiple technical factors converging at a similar price point, it tends to create a stronger barrier. What makes this resistance zone interesting is that it's not at all-time highs. We're dealing with resistance in a broader uptrend, which is very different from resistance at market peaks. This suggests that if we do see a breakout above $84, the path of least resistance could be significantly higher, potentially toward the 90 to 92 range initially, and then toward previous highs beyond that. For traders watching this resistance, the key question is, what would a convincing breakout look like? We'd want to see a daily close above $84 with strong volume, followed by a continuation higher. A quick spike above $84 that immediately reverses would be a false breakout and could actually provide a short-term selling opportunity. The technical setup here is what we call a consolidation within an uptrend. Price is coiling between support and resistance, building energy for the next major move. The direction of that move will be determined by which level gives way first. Industrial demand factor, solar and EVs, 10 quoted 1330. Now, here's where the story gets really interesting from a fundamental perspective. Unlike gold, which is primarily a monetary metal, silver has massive industrial applications, and these are growing at an extraordinary rate. Let's talk about solar energy first. According to recent industry data, global industrial silver demand hit a record 680.5 million ounces in 2024, and solar panels are now consuming approximately 30% of all industrial silver use. Each photovoltaic panel contains between 15 to 25 grams of silver, and here's the critical part. Global solar capacity is forecast to reach 665 gigawatts in 2026 alone. That translates to approximately 120 to 125 million ounces of silver demand just from solar panel production this year. To put that in perspective, that's nearly equivalent to the entire annual output of some major silver-producing countries. The solar story isn't slowing down either. The European Union has set targets of at least 700 gigawatts of solar capacity by 2030. Countries across Asia, the Middle East, and South America are all expanding renewable infrastructure, and silver is absolutely essential to that transition because of its superior electrical conductivity and thermal properties. Now let's discuss electric vehicles. A traditional internal combustion engine vehicle uses about 15 to 28 grams of silver. A hybrid vehicle uses 18 to 34 grams, but a full battery electric vehicle uses between 25 to 50 grams of silver, nearly double what a conventional car uses. With EV production forecast to reach 14 to 15 million units in 2026, that's adding another 70 to 75 million ounces of silver demand just from the automotive sector. And industry forecasts suggest EV production will overtake internal combustion engines as the primary source of automotive silver demand by 2027. What makes this particularly bullish for silver is that these aren't discretionary uses. You can't build a high-efficiency solar panel without silver. Copper substitutes have technical limitations related to conductivity and longevity. Similarly, the electrical systems in EVs require silver's properties for safety and performance. This creates what analysts call an inelastic demand profile. Even if silver prices double or triple, solar and EV manufacturers must continue purchasing because there's no viable substitute at scale. This fundamental demand acts as a strong floor under prices, which directly supports our technical support levels. Supply constraints and market deficit, 1330-16, Doug. Now let's examine the supply side, where the bull case strengthens considerably. The silver market has run a structural deficit for multiple consecutive years, meaning global consumption exceeds annual mine production. In 2025, the deficit was approximately 230 million ounces. For 2026, projections show continued deficits around 149 million ounces. When demand consistently outpaces supply, inventory levels decline, creating upward price pressure. Here's the critical constraint. Approximately 70 to 75% of silver is mined as a byproduct of copper, zinc, lead, and gold. This means silver production doesn't respond quickly to higher prices. Even with silver above $80, levels unseen since the 1980s, miners can't simply increase output. New primary silver mines require 7 to 10 years from exploration to production. Existing mines face declining ore grades, extracting less silver from the same rock. And if copper or zinc prices decline, those mines might reduce production regardless of silver prices. The supply rigidity means industrial demand growth locks in higher price floors. The market clears at whatever price balances physical supply and demand, and that clearing price appears significantly elevated from historical averages. These supply-demand fundamentals reinforce why $69 or $70 support is robust. Below those levels, significant physical buying would likely emerge from industrial consumers and investors understanding the structural deficit. The Federal Reserve scenarios in monetary policy, 16 or 1830. Let's talk about the macroeconomic backdrop, specifically Federal Reserve policy and its impact on precious metals. As of late January 2026, the Federal Reserve held rates steady at 3.5% to 3.75%, pausing after 3/4 point cuts in 2025. Current projections suggest 1 or 2 additional cuts in 2026, potentially settling rates in the 3% to 3.25% range. Market expectations are actually more hawkish. Some traders are pricing in no additional cuts, especially after stronger employment data in early February. Markets currently price in about 60 basis points of easing by year-end, but uncertainty remains high. Lower interest rates generally benefit precious metals by reducing the opportunity cost of holding non-yielding assets. When money market funds pay 5%, there's incentive to hold cash. When rates drop to 3%, that calculation changes, favoring real assets like silver. Let's consider 3 scenarios. Scenario 1, multiple Fed cuts. If the economy weakens and the Fed cuts rates by 50 to 75 basis points, this would likely support silver significantly. Lower rates would weaken the dollar and increase appetite for real assets, potentially pushing silver to break through the 82-84 resistance convincingly. Scenario 2, one cut or pause. This is arguably most likely. If the Fed makes one cut or stays on hold, silver would likely continue consolidating between current support and resistance. Industrial demand would maintain price floors, while monetary uncertainty caps upside. Scenario 3, no cuts. If inflation persists and employment stays strong, forcing the Fed to hold rates, this creates near-term headwinds. However, structural deficits and industrial demand would likely prevent catastrophic decline. We might see tests of $69, $70 support with strong buying emerging. The key point? Monetary policy creates the environment, but doesn't override fundamental supply-demand dynamics in industrial commodities. Silver is unique as both a monetary metal and industrial necessity. Trading the range and risk management, 1830 to 20. Let's synthesize how to interpret this technical and fundamental setup. We have a clearly defined range, $69, $70 support, and 82, 84 resistance. This range-bound trading is typical during consolidation within larger trends. The question is which direction breaks first and when. The evidence suggests an eventual upside breakout is more probable. Industrial demand is accelerating. Supply deficits are structural. Exchange inventories are at multi-year lows. Even without Fed rate cuts, current levels aren't restrictive enough to crush commodity demand. For traders, the range provides clear reference points. A break above $84 with volume suggests a move toward $90, $92. Conversely, a close below $69 points to the 60-65 support zone. For longer-term investors, this consolidation may offer opportunity. Accumulating on tests of support with stops below $69 could work for those believing in the industrial demand thesis. What I'm watching? The 50-day moving average, volume on resistance tests, and fundamental news on solar panel production or EV manufacturing data. These catalysts could push price out of range. Remember, in commodities, fundamentals determine destination, but technicals determine the path. The destination appears higher based on supply-demand imbalances, but the path involves continued volatility and range trading until a decisive catalyst emerges. Closing, 20 post 21 wound. To wrap this up, silver is trading between $69 to $70 support and $82 to $84 resistance as of mid-February 2026. Industrial demand from solar panels and electric vehicles is hitting record levels, creating strong fundamental support. The market remains in a persistent deficit with constrained supply, while Federal Reserve policy will influence near-term volatility. This is purely educational content, not financial advice. Always manage risk appropriately and consult with financial professionals before making investment decisions. If you found this helpful, please like and subscribe. Drop your thoughts in the comments on where you think silver is headed. Thanks for watching, and I'll see you in the next one.